Well, we're going to shift our focus now to the Europe sovereign debt crisis. Hedge funds are moving past Greece and betting that the odds of distress or even default will spread to Portugal, Spain, and Italy. Our next guest is convinced that chain of events is a distinct possibility. Vincent Truglia is managing director of global economic research at Granite Springs Asset Management. He was the head of Moody's sovereign risk unit and also worked at the New York Fed. Vincent, good to have you on the show once again. I mean, a number of things have changed, but a number of things have remained the same since you were last here.
Right, exactly. Actually, only the details have changed. The fundamentals still remain the same. And the eventual default by Greece is just only a question of timing, not a question of if it will occur.
They are making attempts for asset sales. There is a lot of talk about austerity measures, and it does look as if they are trying to push that through. Of course, you know, just a week ago we were looking at protests on the street. Is the Greek government in a position to actually institute any of these changes?
Well, my point is that the debt burden is far too large. And that even if it's written down and if they stay in the Eurozone, they'll just wind up having another crisis at some point in the future. They'll become a serial defaulter. So from my point of view, what they really need to do is find an exit strategy from the euro.
Let's talk about default for just a second, because there's a lot of debate about what a default actually is. Give me when you say that they're definitely going to default, does that mean it triggers all the credit default swap contracts? People who have bought protection against default will actually be able to receive funds as it relates to that? Or is a default mean that they're late on payments on their debt? That doesn't trigger.
Well, actually, there are a variety of definitions of default, and there's a continuum going from a distressed exchange, which is can or may not be a default, depending on how it's interpreted and how much force is being put on the creditors. And then you go to outright default, such as Argentina did in 2001, where they just stopped paying completely. So this is a continuum. And the key question for the CDS market, or the credit default swaps, is really going to be determined by a committee that will decide whether or not it meets all the criteria set up in those contracts. But that's really a legal question. From my point of view, Greece will not be able to pay its debts on time unless there is a complete bailout and a write-down of the debt as time goes on.
Let's talk. We mentioned hedge funds are actually now looking beyond the sovereign debt market for bearish plays. They're looking at the corporate debt market, and they're also looking, of course, beyond Greece. We're talking Spain, Portugal, Ireland, Italy even. Do you think any of the market is overreacting at this point?
No, actually, I think they're picking up the real risk going forward, because once the Greek crisis climaxes, and we're still not at the climax of that from my point of view, they know that the cost of bailing out Portugal and Ireland would be so enormous that you really couldn't supply the kind of bailout that you're going to that they've already provided to Greece, never mind if you added Spain on top of it. So I think markets are ahead of the curve on this, and policymakers are not happy with that, but that's the reality of the situation.
All right, Vincent, we have to leave it there. Thank you for joining us again today. That was Vincent Truglia of Granite Springs Asset Management.